Good morning. This is Barry Knapp with Ironside's Macroeconomics. It's 6:20 a.m. Mountain Time on Monday morning, March 9th. We returned on Friday from a week in New York City, expecting to discuss how the run-it-hot economy that was consensus at our previous trip to New York back in December after we released our annual outlook note was not really running all that hot. And of course, just before we took off, the U.S. and Israel attacked Iran. And so circumstances were a little bit different. The conversations were a little different than we've expected. We included a couple of our videos from our media appearances in our weekly note, so you can have a look at those. The first meeting we actually had was on CNBC Squawk Box as the first guest of the show on Tuesday morning, and then we did a Fox Business interview with Charles Payne later in the week and brought up a couple of ideas. One of them was the theme or title of our note this week, the Petrodollar. And that's what we initially discussed with Joe and Kelly, who was subbing for Becky and Andrew, who were absent that day. The way we structured the note this week was to talk about that petrodollar idea and how it led to a bunch of positioning resets. That's much of what we spent time with clients talking about last week, was crowded positions that the geopolitical shock wreaked havoc on. We then talked about the implications for monetary policy of what we're describing as potentially a fourth adverse aggregate demand shock during the Trump administration. We then reviewed the labor market. We called it the low energy labor market, stealing one of President Trump's names that he calls some of his opponents. And then we recapped some of the ideas and themes that we talked about during the week, called it our New York City recap. So first on this petrodollar thesis or idea, it's something that we developed back in our days at BlackRock in 2014 when we did a research project on the implications of the shale revolution. And we went back and looked at when we first started importing oil in the 60s and what it did for our trade deficit. It was the primary catalyst for most of the swings in our trade deficit from the 70s all the way until the shale oil revolution. And so what we found was periods of high oil prices and tight supply, like the 70s and the 2000s, the dollar was decidedly weak. In its simplest form, we needed to produce more dollars or send more dollars abroad in order to pay for that oil. But in periods of growth in non-OPEC supply, like in the early 80s or the 90s, the dollar tended to be strong. And it's because the opposite condition was true. We didn't need to send as many dollars overseas in order to pay for oil. But what the shale revolution did was it turned the U.S. from the world's biggest oil importer to the world's biggest oil exporter. At the time, we put forth the idea that the dollar was going to become a petrocurrency, and that correlation between the dollar and oil, which had cushioned the blow for much of the rest of the world when we had these oil shocks, dollar tending to go down, made oil marginally less expensive, at least on the margin, during the 70s through the early 2010s. But now the opposite was likely to be true, and it was masked a little bit by the growing goods deficit from the middle 2010s until most recently, although we did see the dollar go up during the Russian invasion of Ukraine. But this is a real change in dynamics. And to us, it exposed one of the most crowded, but least supported by fundamental themes, which was this end of American exceptionalism, buy overseas markets. And we, in the note, show return on equity of the S&P 500 relative to these other markets like the Nikkei, like the Euro stocks, and a number of others, to make the point that if you buy those, if you're trying to bet on the dollar going down, and we do still think by the end of the year the dollar will be 6 to 7% lower on a trade-weighted basis like it was last year, because the administration wants it to be so, and that's part of the trade negotiations that we're having. That said, parking your money in foreign equities rather than U.S. equities means you are buying a more performing asset. I mean, these countries have not sorted out their energy vulnerability, and that was laid bare last week, and you could see that in the relative performance. You could see it in the relative performance again overnight. The Nikkei, which is a market that we like, was down big. The Kospi was down very big. A number of the other Asian markets were down considerably. Europe is in a bad spot. Look at European bond yields this morning. They are sharply higher. They have a much bigger problem with higher oil prices than the U.S. does, and with attracting foreign capital to support their deficit spending. So this is a sort of a key theme to keep in the back of your mind, and it did lay bare this position. When we went to New York, we thought we were going to be talking about the run it hot idea not being so hot, and this fourth adverse aggregate demand shock looked like it could be the start of a bit of a correction related to all those non-tech related cyclical sectors. Now, again, we do think growth will pick up later in the year, but as we noted in last week's note, the markets were well ahead of core fundamentals. Namely, we had pointed to the marking down of earnings estimates for everything else in the S&P besides tech and communication services from something like 10% for the first quarter as of Jan 1 down to less than 5% with the end of earnings season. So this could turn out to be a good entry point, but as we point out later in the note, measures of risk got elevated. The VIX was high. The term structure of VIX futures got inverted. Skew is bid, meaning downside puts are expensive. But this is one of those geopolitical shocks, and the fact that the S&P was only down 2% last week doesn't exactly create a buying opportunity. Down 10 to 12, most likely will be a buyer depending on how things unfold with respect to the war in Iran. And obviously, there's a lot of uncertainty there. Last night, we spoke to a client with S&Ps down 150 and oil up at $115 or so. Obviously, things look quite a bit better when we got up this morning. Sort of anxiously looking at our Bloomberg. Fed officials are at risk of making the same mistake they made a year ago, looking at tariffs in terms of the first order effects rather than what's going to be the second order impact on demand. We understand why the ghost of Arthur Burns and the supply shocks of the 70s bother them, but there really isn't an issue for the Fed here in terms of inflation unless there is a fiscal response to this, and meaning they try and pass through reconciliation some sort of energy subsidies or some other support for consumption, and that's why we have this chart in the background of swap spreads. We've used this as an indicator of concerns about supply and noted that throughout the course of last year, as government spending growth slowed from 11% to 2%, swap spreads tightened almost relentlessly until January, and they started to go down. And there's a couple of factors at play here. One is IEEPA tariff refunds, which will blow a little bit of a hole in the budget. And then the possibility that President Trump does get a very large increase in defense spending as part of his budgetary asks for this year. The initial ask of Congress to fund the war is only $50 billion, which is not going to leave much of a dent in the $7 trillion a year in spending. But if there is big expenditures over time, then this wars cost money, I suppose, is the simplest way to think about this. So that was, again, one of our big takeaways from last week, was the bond market reaction to this. We talked to a number of investors about it, and I don't think no one we had spoken to had really picked up on the swap spread starting to go deeply negative again as an indication that maybe this could blow a hole in the budget, but there it is. As far as the labor market goes, in our preview note a week ago, we thought there would be payback for the January seasonality, which has been distorted by the pandemic, less seasonal hiring and less seasonal firing. We noted that in the years from 2000 up through the pandemic, we tended to have about a 2% reduction in unadjusted employment in the month of January. Since the pandemic, that's only been 1.7%. The BLS numbers smoothing process hasn't caught up to that yet. And sure enough, we got a big negative revision, and we got a very weak number in February. Yes, there was a strike, Kaiser Permanente in California, that reduced healthcare employment by about 31,000 jobs. Number was still minus 92,000. People unable to work due to bad weather. It was actually lower than normal, although there was bad weather in New York and snow in New York in the east. But this was just a weak report from that perspective. We did get the annual population control adjustment, and sure enough, the unemployment rate was higher than they thought in prior months and went up again in February. It's still below where the Conference Board suggests it should be, and that should be of some concern to Fed officials. And we had also expected, we thought that the labor force participation rates looked a little strange to us. Sure enough, with the population control adjustment, that got marked down quite sharply, 0.5 point. That is a big adjustment. So there's not as many people working. The labor market is the furthest thing from in balance. We're going to get JOLTS numbers later in the week. We noted in some discussions that the churn in the labor market is the biggest issue from our perspective. We need that for skills matching. We need that dynamism. It drives up real wages over time and labor productivity over time, and we don't have that right now. That should really concern the Fed. We did then move on and discuss AI a little bit, because tech employment, information technology employment, is the third weakest of any of the major categories that the BLS tracks. It's falling at a 2.25% annualized rate, but average hourly earnings for tech workers at 5.8% are the highest. So it seems that the tech sector is firing their least productive workers and paying their more productive workers more. That could very well be AI. They were the first sector to adopt the internet-related technology boom in the late 90s, and it seems to be happening again. And we saw the same thing by doing bottoms-up sort of sector analysis on the S&P tech sector. Employees were down 1.9% in 2025, but sales per employee were up 16.7%. So there is something going on with AI and productivity, at least in the tech and comm services sectors thus far. So a couple final wrap-up comments here. Obviously, we can have more to say about the war, but we're going to leave that aside for now, and try and keep you up as best we can with our views on that. If we get a really impulsive sell-off this week and have developments that lead us to believe it's been overdone, we'll try and make a call on that, but we haven't seen that yet, as I mentioned. There was some interesting comments we heard from one client about this whole tariff impact on inflation and how the corporate sector was overconfident in their ability to pass through prices going into the tariffs, and found that conditions were not in place to do that. This was our thesis all along, but we continuously heard this from corporate America. Fed officials talked to corporate America. They thought, yeah, we can pass prices through. They couldn't. That's because the fiscal and monetary conditions were not in place to be able to do that. Why the Fed didn't understand that, we don't know. Must have to do with the way they've been educated over the years, but we thought that was really interesting. And then we heard Tom Barkin from the Richmond Fed make that comment as well. So maybe some Fed officials are starting to get the joke on that one. We had some comments in the note about what Bruce Richards said about the software sector. It was interesting. In essence, the core of his thesis that there's going to be a problem in direct lending and in CLO markets related to software was most of these companies, the leverage that they've taken on to borrow the money that they've borrowed means they don't have the free cash flow to invest in AI and will struggle to be AI forward software companies. Whereas the big, large publicly traded companies will be able to invest in AI and will be actually enhancing the use of AI and will find a way to make themselves useful in the AI world. So that was an interesting thesis nonetheless. We can't really speak to his default projections. We didn't really try and dig in on that too much, but we thought his core thesis was interesting nonetheless. So a couple of final thoughts here. One was, I think we might have found a way to think about Bitcoin relative to gold. We've talked about gold in the global reordering of trade dynamic where China's not accumulating treasuries. Instead, they're looking for an alternate asset, and that being part of a core gold theme that could last for years if the U.S. trade deficit truly is going to shrink and China is somewhat successful in diverting their massive excess manufacturing capacity to the rest of the world. Bitcoin perked up a bit during the middle of last week till the slump on Friday at least, because we view that as a play on excessive spending and debt for the world's reserve currency, i.e. the US dollar. So this whole swap spread going deeply negative was the catalyst for Bitcoin rallying. So we're going to think about Bitcoin as a play on profligate government spending in the US and what it means for debt over time, sort of an alternate to the US dollar, whereas gold being a source for or a destination for currency reserve managers who aren't buying treasuries anymore because they're not exporting to the US in the way they once were. So it's an idea. We'll see how that plays out. But anyway, that was one of the interesting developments that we saw last week. So that's it for me. Again, keep your powder dry. We think we may get an opportunity to put some money to work here. But there's quite a bit of uncertainty around how this thing's going to unfold. Again, the U.S. is the least vulnerable market, but we never really liked that end of U.S. exceptionalism trade. We still don't really like it. Bearing that from Ironsides. Have a good week, everyone. Thank you.